Don't do either.
This is Bob Barton. He's the CEO of Catalyst Financial Corporation. He has 40 years of experience financing energy business.
Don't do that.
Without further ado, this is Bob, a close friend of mine. Thank you so much, Bob.
Good.
A warm welcome.
Good. Okay. Yeah. Hey there, everybody. Well, thanks. It's kind of hard to believe everybody's here on a rainy Friday night. This is good. Maybe that's why you're all here. So, yeah. Well, thank you. And I'm going to probably spend, an hour and a half. Originally, he said, can you do something for 2 hours? I said, I don't think anybody wants 2 hours on a Friday night. So maybe, but I want to make it interactive. So what I want to say is, as I go through some of what I'm talking about high level conceptually, and then I'll give some specifics. And actually, I want to give challenges, because I think community investing actually isn't happening very effectively yet. And we're a long ways from go. It's almost like the locavore movement. It took a long time before people started buying local. And community investing is very similar. It's a concept that's getting popular, but is hard to implement at this point. So I'll give a whole bunch of ideas. And you guys can ask questions on slide by slide rather than waiting to me to stop talking or something. So that way, just interrupt and ask questions at any time. So we're going to start, because it's Friday night and it's late, we're going to start with a song and see if anybody knows who this is.
Pink Floyd, yeah.
Wow. Pink Floyd. Okay, good. You guys are good. All right, that's right. And so hopefully we could do more sharing, with our money. Pink Floyd was saying, he wanted to share it, but don't take mine, more or less. So anyway, we want to share our money. So I am psyched about starting here for you guys. So I'm going to give you the 2 second. I'm hit 64. I'm almost 65, and I've been doing this most of my adult life. So for the last 36 years, I've been helping finance social change businesses and triple bottom line companies. And that's taken... Triple bottom line, who asked that? Okay, good, thank you. So if I use jargon, please let me know. Triple bottom line company would be a company that cares about profits, cares about people, and cares about the planet. So people, planet, and profits, all three. So you wouldn't be investing in a company that was really profitable, but that was really hurting the environment or was really messing, wasn't fair to people. So triple bottom line has been around for quite a while, and there's been a bunch of groups. We've worked in the private sector a lot, and I just only mentioned one client. We worked with Stonyfield when they were losing about $2 million a year, which was a long time ago, as you can imagine. That was 20 years ago. But we had real faith in them that they would make it, and I had a lot of faith in Gary Hirschberg. So I brought in a bunch of investors to help him early, which wound up becoming a good thing. We've worked with a lot of utilities, so we've designed a lot of utility finance programs where utilities may want to finance energy efficiency, but rarely do they want to use their own money. So we've been hired to figure out, okay, we're mandated by public utilities to provide finance programs, but we don't want to use our own money. What can we do? So we've designed a lot of finance programs bringing investors for utilities. And I mentioned a few, but we've done it for over 30 utilities around the United States. We've been advisors to EPA for a long time and to the DOE. So anybody in a public sector, we've been public sector advisors, meaning if a city, county, or state government in the United States goes to EPA and says, I can't figure out how to finance efficiency, my company gets deployed to figure out how to work with them. And we've been doing it for 10 years. We're currently managing about $100 million for ARRA funding for DOE, and we work with a lot of cities and counties.
Do people know what the ARRA funding is?
Oh, ARRA funding, sorry. Stimulus grant funding. Yeah, that's good if I do jargon, sorry. Stimulus grant funding that went to cities to figure out, how do we promote economic development and jobs. My particular task was I'm working with cities like New Orleans, where we just came back from, Austin, Texas, Plano, Texas, state of Kansas, all have money. Collectively, my clients have about $100 million, and I'm helping them leverage it to about $1 billion using private sector money to do energy efficiency improvements and renewable energy. So that's kind of fun, and each one has different sets of problems. And in the end, we've basically arranged, which means I've been lucky enough to get investors to write checks for over $1 billion in the energy field. So that's what I've done for the last 34 years, and we have a small team. There's 5 of us, and we love it. So,
Bob, are those last line of investors individuals or businesses? Or you said you arranged.
oh no, the money that was arranged for was typically for a few $100 million for businesses, probably $300 or $400 million for public sector, which would be cities and counties, and about $750 million actually for the federal government for bases and places like that where they wouldn't put their own money up, and we were doing things called performance contracts. And a performance contract, which is not what you guys want to hear today, is just basically a contract where somebody comes in and says, hey, we're going to guarantee you savings, and just give us your dilapidated building, and we'll make a promise to you about how much you're going to save. And they're pretty hard to get financed in the early days, so we've provided a lot of financing for those promises. So I'm going to ask you guys a group question, so I don't have to talk so much. Why are people here tonight to invest locally? I mean, what's motivated people to even come here tonight? There's about, looks like 20, 25 of us here. Tom, I'm sure you have a reason. Not because you want to hear me talk.
I do. It's interesting that I actually sold mutual funds part-time for about 20 years.
Wow.
But a lot of the companies that the mutual funds purchase stocks in are companies that have been paying their CEOs millions and billions of dollars while laying off companies and sending jobs overseas, doing some not very nice things to the environment. And so I decided that morally I didn't think that was a good thing anymore. And so I've stopped selling those mutual funds and want to take my own IRAs and 401k money and put it into a self-directed IRA so that I can invest in local projects like the Brattleboro Food Co-op solar roof, biodiesel project down in Greenfield, and hopefully some projects here in Putney.
Yep. Thank you. Yeah. I understand the mutual fund thing pretty well. It's kind of hard to get excited, even if it's a Calvert or Pax or whatever, because even though they're screened,
yeah, and then when you look
it's not in your
look
community.
Look at what the companies that they
It's
invest
not
in.
in our
It's
community.
real exciting.
Right, it's a Fortune 500 firm typically, or Fortune 1000 firm. How about other people? Yeah.
Actually, I have a question first, and then
Sure.
I've got this sign-up sheet, and it says, "Keep me posted." Survey candidate is the second thing that says.
How's that?
There's a thing to check up on the sign-up sheet that says
Yeah.
survey candidate. Do you know what that is?
Survey. Oh, well, I mean, that was going to be circulated at the end. But it's okay. So if you're not confused, I'm surprised. The survey is, we're going to probably do a survey later on to ask people in the community, a broader survey, about like how interested they are in local investing, why they're invested, and formalizing it. Because if we as a community are really going to do something, we have to figure out what are our resources.
And
So,
it's
and the
anonymous.
survey can be anonymous too. We don't expect people to have to sign names and stuff.
Thanks. I'm just going to answer your question, Bob. I didn't sell mutual funds ever, but I do have.
But you're aspiring to?
And I don't aspire to, but I do. I would like to have my tiny retirement account invested in something other than what it is, if that's a possibility. I got very jazzed when Michael Schumann came the first time to Putney and was in, we were at the Putney Central School gym.
Yeah.
And there were, I don't know how many people were there, more than 100?
120.
120 people. And he said, how many of you have your money in that, in a local bank? And, 110 hands went up. And
Right.
he said, how many of you have your retirement account invested locally? One little hand went up.
Right.
And so it's like, oh, wow, yeah, like, is that possible? Can we do that? So that's why I'm here tonight.
Okay, great.
Well,
And I should answer that question too, because actually I think the answer is controversial about whether you can use a self-directed IRA. And I talked to a tax attorney to tell you about that. It's SEC lawyer, actually.
Well, my husband and I are relatively newcomers to Putney. We moved here a year and a half ago. And when I arrived here, I realized I was finally home. I've lived all around the country and never felt at home. So this is my home, and I love this place. And I want very much to be part of creating a strong economy, a strong local economy, and just, having a real community that is not part of the global, community. And one of the first things that I knew that I wanted to do when we moved to Vermont was to start investing our money in Vermont and also in alternative energy. And that was so we've been trying to do that since we moved here. And when Michael Schumann asked that question, I was so glad he asked it, because we've been looking for opportunities, particularly locally, but also statewide. And there's very, very few opportunities. And we also have to balance it with the fact that we do need some income. We live off that income, so we have to have some income to be able to live on.
Right.
But there's very few opportunities. So the idea that we might be able to do something here and that we could be part of is really, really exciting.
Well, I think collectively we're going to invent the answers.
Good.
There aren't any simple answers right now. I was in a meeting this morning, which I got really inspired with Paul and my first time coming. It was just 4 of us, so John Berg
And Ward. And
Ward was there, and we just started chewing on how do we make this happen? And so I think more and more of this is going to happen for all of us because we're hungry for it. Yeah.
So what is the legality behind a self-directed IRA and the laws that would actually allow us to do this?
Well, I think we probably need to get more than a few opinions, but the lawyer that I use is Ken Merritt, so I'll mention he's the head of the Vermont Angel Network, and he's an SEC lawyer in both New York and Vermont and Massachusetts. And when I spoke to him today, he said that you could not use a self-directed IRA to make local investments. That the beneficiary of the IRA has to be an accredited investor if you're making it into a equity investment or debt investment, particularly in a company. And I'll talk about the specifics more. But I wouldn't stop at Ken Merritt, even though he's my attorney, and he said that. I mean, I've never read Michael's book. And I'm an optimist, and I think things can be changed. There are ways to invest in local businesses, but it may not be directly through an IRA. It may be more, as we talked tonight, about being a member in the co-op. You can be a member of Co-op Power, and there's no question you can invest.
Yeah.
You could also buy power, as an investment, and that will work. So there's different ways to get around these laws. But
that wouldn't allow you to use, say, retirement funds to do that.
It would, yes, it would. You could use any types of funds for that. The self-directed IRA, mostly people have been using it because, well, maybe, let me answer this SEC question here, which will actually answer it in detail. Okay? And if you don't get an answer, just say, hey, Bob, you didn't answer it. Come back to me and bug me. So what about, do other people have reasons why they want to invest locally? Howard or SC?
Well, I'm not looking to invest. I invest in my own business, so that's pretty local. Go out my back door. But
Westminster's pretty far.
But when I'm not running my own farm, I actually spend time in Nepal and I train farmers or former guerrillas to become farmers.
Wow.
And one of the interesting things that I found out is that our government has been investing in infrastructure to allow farmers to get their produce distributed to the major markets as part of our foreign aid.
Yeah.
And it struck me that wow, our government does nothing like that here.
Yeah.
Okay, for
Right.
our farmers.
Right.
So I'm there, and seeing it's like. Wow, of course it was a great idea to do that there. But of course it's a great idea to do that here.
Right.
Why not help local farmers with food storage facilities and the things I'm training them to do when I'm over there?
Right.
So anyway,
Right.
I don't know, I know this isn't, you're not going to specifically, I just wanted to try to get a little background and see, that's my interest, of trying to get money invested in that.
Anybody else want to say something? I don't want to cut anybody off. Yeah.
To prevent the leakage of our funds from going elsewhere and to keep it local and to get that multiplier effect of
Great.
I'd like to see Putney really wealthy,
Aha, good.
locally wealthy.
Keep the money local. Right. Somebody said to me this morning, wouldn't it be great if we really had a bookstore in Putney that stayed? You know, and I don't know if maybe that will happen one day, you know. I know it's been hard for the guys that have tried. Yeah.
I'm just wondering if you can give us a little bit of an overview of what happens in a community when the money does stay local. Because I think we all sort of have a sense of like, that sounds like a good idea, but how does it actually really work, and what does it do for a community when you can do that?
Like a role model? Is it what, like,
Yeah,
we
kinda
point,
like-
you point to.
Well, I
place
think there are
that it's
people
worked.
smarter than me, because I've never really analyzed it that way, but I mean, there's a lot written on about the multiplier effect of dollars. So, I mean, and, you know, exporting versus importing dollars. And it's clear that if we can support local businesses and nonprofits, then the dollars are going to literally stay here and not be exported out to wherever else we're investing. And then that's going to create a more vital economy. I mean, I don't know the specific numbers. There have been reports written like for every dollar you spend in your local economy, the secondary effect is 8 to 1. You know, I mean, and I think statistics can always, you know, make the case for whatever you want to do. But there's no question that if all of us were to spend more money in the local economy, we would have a more vibrant economy.
Yeah.
But I mean local. I don't mean to be provincial like I'm talking Putney. I mean local, and as I start on another slide, local may mean to us to be not just Windham County. It may be all Vermont, or maybe, you know, tri-state region, you know, or within 100 miles of us. You know, it's. So I don't know if that was probably answered you. It didn't answer you in a specific way.
Yeah, I mean, just be interesting if somebody could kind of explain that, because I sort of in my own head, it's sort of like, hey, I know this is a good idea, but it's kind of unless somebody can say, look, this is what happens when you invest a dollar in a community,
Right.
as opposed to having to leave the community.
Did you want to answer
Well, I
that?
think there are multiple processes at work where you have, like, for example, Ashland has a buy local campaign. And the effect of that is to plug one of the holes, or to attempt to plug one of the economic drains for current stations and dollars leaving the town. But then you also have other means of investing locally at various levels. So I think just looking at it from, you know, what would the town look like if we had a successful buy local campaign or a successful local currency,
Right.
doesn't take in the full picture of, well, what would it look like if we really brought serious money into town through local investing mechanisms, either through a business development or through a merc exchange or through any number of other, you know, even higher level investment mechanisms. And I think that's the exciting part of what we're looking at is a multifaceted approach to really enhancing the town.
I mean, I think it's clear, too, that we create more jobs because, like, just say taken on an agricultural level, if all of us choose to buy tomatoes from Howie has to start from the seed, and then he has people doing every piece of the process, versus if we get a tomato that comes from Guatemala, what we do get is the local store, we pay the local store and they get money, but we've missed the whole front end piece, you know, because we haven't had anybody's workers cultivating it. We're only capturing a part of the whole value chain. That's the way I would see it. So to the extent that we can, yeah, this is good. Boy, you know, I'm not going to talk tonight. Oh, it's good. Keep going. Yeah.
Well, something just occurred to me that I think there's a bigger, maybe not bigger, but there's another side to this whole discussion, and that is the question of democracy and this co-governing and cooperative concept that we're really talking about here. Because if you look at, I mean, it occurred to me, you can look at different communities and see what happens when they focus more on localizing the funds. And it's going to look different for different communities. For example, I moved here from Pittsburgh, Pennsylvania, and there's a lot of, there's of course, global corporations, and there's lots of money. It's your classic big city that's screwed up, but there's a lot of local investing as well. A lot of the local developers get a lot of money from the city government, which is the worst thing in the world because they're all the wealthy elite, and they tear down housing in order to put in stadiums. So sometimes that local is not it's not the whole thing. What you also have to look at is who's making these decisions. And when you have this hierarchical, top-down, very elitist mechanism in place, government in place, then it isn't going to help the people. I don't care whether it's the money is predominant local or half local, it's still only going to go to a very small number of people. And what's really exciting here is that we're creating a cooperative decision. We are all coming together to decide what we want to do, as Putneyites or as Windham County,
Sure.
and we're going to create something that isn't going to benefit just an elite, that funds are going to be funneled to just a few people, and then the rest of everybody else is going to be left high and dry.
Well, I'm going to talk a little bit about the elitism because investing certainly has a fair share of that, as we'll find out in a second. It's actually not that easy to invest locally, which is, we have a road sign there, and you see we're going all over different directions. And hopefully I'll give you some signposts. But from a big picture level, like just think of you guys as investors, what really derives where you invest locally, whether it's in Putney, Windham County, or Vermont, is in the long run it's going to be these three things. It's going to be four things. Your risk tolerance, can I lose money, not lose money, what kind of rate of return do you want on your investment? What geographic area are you willing to go? So if you say Putney only, that's different than Windham County, that's different than Vermont, it's different than if you're willing to go to Keene. And industry preferences. So every person in this room who really wants to think about doing local has to at least define for themselves, where they are in that spectrum of both risk tolerance. Because the person that says, this is my 401k and I can't lose a penny, is really different than the person, somebody I spoke to this morning at our meeting who said, I want to make investments that, but for my investment, it would never happen. I said, well, that's really high risk. He said, I'm ready to lose it all. That's a really different part of the spectrum. It's like, lose it all, can't lose anything. Well, guess what? Those are really different types of investments. And so when we get to rate of return, it's the same thing. There are people that will invest and say, well, I want a market rate of return. Well, what is market, And so does that represent, if you're lending somebody money, you have to give it at 5% or 10%, or you're happy at 2%? There's no right or wrong here. There's definitely no right or wrong. But each of us has to decide on that when we're doing it. There's been some things I've done at 0% interest. There's other things I've made 30% on. And I feel perfectly good about both. Because the risk is entirely different, and the people are different. So high impact social investing, to me, I'm fine to make little or no money. But on things that are higher risk where somebody else can make a lot of money, I'm not going to take 2% when they can make 30 or 40 themselves, So there's term, it's also what you're expecting. And then there's this piece here. There's a lot of things to think about. So say, well, types of companies, types of projects. So if you look at the first one here, if I'm in your way, I'm sorry. You have to really figure out, like, what stage, if you're investing in a company, am I willing to feel comfortable with? Am I in startup phase? One of the people I spoke to this morning said, I think startups are great because they can't get funded easily. And they are great. And if you want to do that, that's going to probably be in the higher risk spectrum. Or whether you do invest in early or late stage companies. Do you invest in profitable companies, near profitable companies, companies that are far away from making profit? Those are really different profiles. And most of you probably haven't had to think about that yet, but if I'm helping, having raised over $1 billion, I have to have these things each. For every investor I work with, I have to know these things really, really clearly. High risk, low risk. Do you want to invest in a seasoned management team? And you say, well, yeah, of course I do. But a lot of the new deals we're going to see here in Putney or in the community are from people that are budding entrepreneurs. And they've never done this before. They might have been a computer geek, and now they're in farming. It doesn't mean they're not going to succeed. I know I was really conservative years ago, and I did not invest in Ben & Jerry's. Because I figured, I kind of looked at them and I said, well, they're going public and they're well-meaning. One guy's a potter, the other guy's a teacher. And what do they know about ice cream? I totally blew it. I just didn't see that these guys could make it happen, Other people did. They said, hey, I invested very late in Ben & Jerry's. I didn't get in that really $5 a share stuff because I was too conservative, If we say to each other, we only want to invest in triple bottom line companies, so I'm in your way, sorry. In triple bottom line companies, for me, that's where I want to personally do my investing. But that's also a restriction for some people. Some people might say, well, it doesn't have to be triple bottom line. It can be just a good local community company. Again, no right or wrong. It's mostly, you have to make that decision, though. And then defining location is really important. So how do we go from Putney or do we go to New England, And we're at home here and we can invest here. But there's also, like I invested in a fund many years ago called the Institute of Community Economics. And I did it at 2% interest. I did it about 20 years ago. And they invested throughout all of New England in worker-owned co-ops and land trusts, of which both to me really made a big difference. But I also knew they weren't just benefiting Vermont, because they were doing Massachusetts and they were doing Maine and they were doing New Hampshire and Maine. Now I actually looked at their website recently. They're in 30 states. But I feel comfortable about that because I feel that their mission is so strong that for me it didn't matter whether they only did Putney. They were doing things to me that I really believed in. And I'm not saying that's what people should think of, but you just have to come to a decision at some point. So when you're investing, you've got really two major decisions. It's like, am I going to invest directly in a company? It's like, is everybody going to invest in Bob Barton's company, Josh's company, whatever, a specific company? And if you do that, you have a little bit higher risk, because you're making one investment in one company. An example of where we could have done it, is did anybody here invest in the Brattleboro Food Co-op notes? Yeah. So that was, what was it? It was like from 1 to 4%, I think, right?
Oh, previously I've gotten 5 or 7%, 10, 15 years ago.
Yeah.
More recently it was 3 or 4.
Yeah, because it was low. So, anybody could have...
That's high compared to what the banks have done.
Right, so any one of us here could have, which is great, because if you were a member of the Brattleboro Food Co-op, it's the key thing. You couldn't be a non-member. You would have been allowed to invest in a loan to the co-op. And the co-op raised $1.2 million. And I've been a member, I was on the board for 4 years. I've been a member for about 30 years. That could be a great community investment because it's really a vibrant part of our community. I don't know whether Putney Co-op's ever done that, raised money from its members. Does anybody know?
Yeah.
Have they? So that's an example of where we could really invest locally, very directly and easily, and pretty safely, quite frankly. The Brattleboro Co-op, the only risk to investors, from in a full disclosure point of view, is the bank has a senior position before anybody that was a member, which means the bank has to be paid first, and the member, and if it doesn't get paid, then the member loans don't ever get paid off. But it's probably a small risk rather than a huge risk. We can invest directly in nonprofits, and we can invest in projects. So that would be the other way to invest directly. So if somebody here, I see Peter Thorell is not here, but I'll mention it, and Josh is here, they work together as a team. Peter Thorell often has projects that are all local here within probably 20, 30 miles. And there are many times he would be really happy to have investors to put some debt or equity in his solar projects. And so that would be a direct investment into a local project, Now, if we're doing indirect investments, I'm going to start with really what we already know, which is where somebody said, do you guys have any money in a CD? Well, we can invest in local banks. And the best we probably can do in banks, is to, and I have to say right at this point, I was part of the founding of the Vermont National Socially Responsible Banking Fund 25 years ago. I was the first investor. And I think it's become, because there's been so many acquisitions, it was Vermont National when I was there, and then it became Chittenden, and then now it's People's. And now we have out-of-state ownership, which is really far away and it's not locally owned. I think there's a lot of greenwashing happening now. But it's still, from a banking point of view, probably still an opportunity to take your money and to put it, you can segregate it in the bank there, and you can say, I want my money to be in the SRB account, Socially Responsible Banking Account, and then it has to go to only 5 or 6 different designated areas. Good community banks, quite frankly, would do similar. And when I was there, I think what got me excited, I was never at the bank, but I was an advisor to the bank and an investor, was David Berg, who ran that. I don't know if anybody remembers David Berg. Anybody here remember him? He was a genius. He was like, on a scale of 1 to 10, he was like an 11. He was off-the-scale genius. And he ran that in a way that he'd take somebody that the regular part of the bank would not lend to, and he'd figure out how to lend to them. He'd go like, all right, this is the way we do it. And I can remember some examples of real crises that happened where nobody would lend, and yet Dave would figure out a way to do it and still not make it unsafe by bringing in money managers in town like Prentice Smith and his people and local investors to help out in creative ways. And that became actually the most profitable part of the bank when I was there as an advisor, the socially responsible lending fund, which is ironic because when they started it, they thought it was going to be the least profitable, and they were totally terrified because they said, you can't do all those good things and make money. And it wound up that David was just smart, that he figured out how to do good things and make money, you know. So we could do that. It's not that exciting, but it's at least, it's an option. Credit unions are a little bit more exciting, although they're small, and River Valley, I don't know what its asset size is, but it's not huge. But I imagine they're open to, I mean, they definitely want to support the community, and because they're not regulated like a bank, they can do things that a bank can't. And in fact, banks and credit unions tend to have a big tension because credit unions don't pay taxes, which means immediately they have about a 30 or 40% advantage in profit. Because the bank has to, for the dollar they earn, has to pay their taxes, and whereas the credit union doesn't. So a credit union can give you a better deal, quite frankly. I mean, if you really look at the products, they can be priced more competitively than a bank. They may not be as robust in all their offerings, but they can be good. And in my experience, they're way more human scale-oriented. And I'm a member of the Vermont Credit Union, the State Employees Credit Union, and I think they're extraordinary. I'm not a member here, but I think they're a good place to go.
I have a question, actually, for everybody, because we have our money in the credit union, and I've actually heard that they don't.
This one here?
Yeah, the River Valley. I've heard some complaints that they don't really put their money into Putney very much.
Into what?
Into Putney, that they don't invest much in Putney.
If it's true, then
Yeah,
that would be a good thing to sit down with the bank president or somebody there to find out, you know.
I don't know, is that really true, or is that just a rumor? And I don't know, does anybody know?
I know that Eileen Fahey has been looking for places in Putney to put money. In.
Can't hear you?
Eileen Fahey is a loan officer there.
Uh-huh.
She's been a loan officer 20-something years, 30 years.
It would be easy to find out but by looking at their annual statement,
Yeah.
you know, and also just to ask some of the loan officers.
So if they're not, then I guess maybe as a group we could go to them and say, look, you're in our town.
Well, it would be like, where else are they putting their money? You know, I mean, it's not likely that the River Valley Credit Union is making a loan to Waitsfield, Vermont, you know. Nobody's probably going to apply to them.
I mean, it might be Brattleboro, but...
Yeah, yeah. But even that, I mean, that to me is still part of the closer region, but it depends how you define it. The next layer up, which is a bit more exciting, is there's a lot of revolving loan funds in both our state and nationally. And revolving loan funds are, well, I'll just give one about, like, say, Vermont. We have the Vermont Community Revolving Loan Fund, which is run out of Montpelier. It was started about 23 years ago. They have about $25 million, and all their lending is for affordable housing, mobile homes, daycare centers, healthcare, small businesses. And so they're very focused, and they'll do types of lending that banks will not do. And lots of times they use their money to be in a second position. So the bank might say, okay, got a $100,000 project, and we'll give $50,000. So the entrepreneur goes, oh great, I got half of what I need. Where do I get the other half? So they get some money from family maybe, and then they get some money from the community loan fund. So without the community loan fund coming in, the bank will not do it at all. And that's the type of role they do. There are many of those institutions in the United States. There's about 1,000 almost nationwide. In Vermont, I don't know how many we have. We have at least 5 or 10. And Vermont Community Loan Fund being one of the biggest. So if you would, any one of us here would be allowed to, no matter what our status is, accredited or not accredited investor, which I didn't get to yet, invest in those in the Vermont Community Loan Fund. And right now you're getting like 1 to 3% depending upon the term that you're in. So it's not a high investment, but if you have money sitting in the local bank at 0.2% in a money market account, it looks great, you know. And you can pick and choose those. Another way, Daniel had talked to me about this a few months ago. There's a group, REIN, which is a Renewable Energy Investment Note. And it's put out by a group called New Generation Energy, or New Energy Generation?
New Generation Energy. They're out of Boston area.
So they're a group out of Boston that basically said, we want to give investors a chance to invest local. So what they've done is they are investing in all 6 New England states and in New York only around renewable energy and renewable power. So if somebody puts money into there, they get between 1 and 3 or 4%, and then they make loans back to investors, to businesses. The founder put in about $500,000 of his own money, the guy that started the nonprofit, to kick it off, and they've raised about $1 million in grant money to do all the legal documents. And they've said to Daniel, and I talked to him years ago, he said that he would help with us if we wanted to do something like that without using his group to show us how he did his stuff. But so that's an example of where somebody who's really excited about renewable energy could say, all right, I'm going to put $10,000 into this, and I know it's only going to be about renewable energy, and it has to be in New England. I imagine if we had enough money, we could get them to say, great, we've got a bunch of this, and we have $100,000 we'd like to put here, but we want all the money to go into renewable energy in Vermont, not in Massachusetts. And I imagine that might work.
So are any of these actually securities that you could take money from a retirement fund and invest in? Or
You could use your retirement money to do this. Yeah, you want to actually hope it's not a security, in a sense, because you wind up getting into SEC rules and regulations if it is perceived that way.
So, but in other words, there is, because it seems to me, I mean, I don't know whether anybody here is sitting in a big trust fund or not, but a lot of the people that I know aren't, and so that the only money we would actually have to invest
Right.
locally would be something that's already in a SEP or an IRA or something like
Could
that.
be, right.
At least for me, I mean, the one thing that I'd be really interested
Yep.
in is what are those things that I can actually invest in using that fund?
So, and yours is self-directed, your particular IRA? Or is it like you got a hodgepodge of here's 10 things you can invest in?
Actually, I mean, it's mostly all in cash now because I just took it out of the stock market. But so
you
self-directed
do you
in that
direct it?
sense.
I mean, you direct it yourself where it goes, or does someone else make the decision?
Well, for the last few years, I've been making that decision.
Yeah.
It's not-
So it sounds like, I mean, you could do it, into any one of these things. Now, they're low returns, so part of what we were talking about is the kind of return you need. So from a retirement perspective, you probably want to balance, getting some little or no return in some ways, but some portion of your portfolio making higher. Where you get that safely these days is a good guess. I mean, what we said 1 month ago that was safe,
Right,
maybe
safe today,
this
not
month doesn't look too safe,
Well, and that's basically why I'm not investing in anything. It's 90% cash.
Yeah, yeah.
But at that point, it's a money market fund at Fidelity. It's paying
Right.
1/3% or something like that. It's not really. I mean, it would be much better to be making 2% and not be paying a 1% brokerage fee, and actually getting at least some sort of a legitimate return while you're not sure what's going to happen with the
Right.
rest of the economy.
Right.
Plus, Fidelity has access to your money, and they're leveraging it in their ways. Which
So I encourage you guys to look at the REN note. You can Google REN. You can Google New Energy Generation. I really encourage you to look at the Calvert Foundation. They do some really exciting things. They basically have aggregated $250 million over the years of people's money, and then they reinvest it in revolving loan funds, which is the tier higher. So what they've decided is we don't want to directly invest in a project. We want to invest indirectly by investing in a fund. And they've invested in a lot of very super progressive funds that are funding community economic development all around the United States.
Is that Terry Muller's fund?
Terry Mona, yeah.
Yeah, we should have him come up and talk to us.
We should. He's going to be staying at our house next weekend. Maybe we can get him to talk here or something. He'll be here for the weekend. Yeah.
That's the Calvert one?
The Calvert Fund. He's on the foundation's board. Yeah. So, other ways to indirectly invest is to invest in funds, and I starred these two. Most investment funds and most limited partnerships require, if you see there, an accredited investor, and I'll give you what that is.
Could you move
Oh, I'm
away
sorry.
from the screen, please? Thanks. Thank you.
So, for the average investor, the last two options are not really easy, because you need to be an accredited investor, and I've got the legal definition here. Well, maybe it's further down. It basically, the long and short of being an accredited investor under the current law, which just changed and made it harder this year, is you need to have $1 million in net worth, not including your house. So if your house is worth money, it doesn't matter. You can't count that in. So you have to have $1 million aside from your house, or you have to have made $200,000 a year the last 2 years, and a guarantee that you'll make $200,000 this year. And if you meet either one of those criteria, you're an accredited investor.
In fact, to
So it's a
invest in a limited liability partnership, you have to be an accredited investor?
You can't, I mean, all these private placements into companies and real estate partnerships and venture funds, everyone has about 10 pages on the front page of the offering that says, you must be an accredited investor. And then you have to sign a subscription agreement that's about 8 pages long that says, I am this, I am not this, and I'm this, and this, and this. Because you and I, if we did it and we were not accredited investors, would not get in trouble. But the entity raising the money, if they took money from a non-accredited investor, could get in a lot of trouble with the SEC. I mean, they could get fined immensely. So unfortunately, it's a form of classism. In a sense, it excludes a whole bunch of our population. It excludes 95% of our population from investing in a lot of common vehicles.
Is there a way that a group of people can aggregate funds to be accredited investment group?
Not really, because it's about the individual. There are things that you can do similarly, which I'll talk about later, but it's government rules and regulations. It's like they have what it is. So when we're investing, we're going to always have two choices. You can invest in equity or debt, and it might go. First of all, am I going too fast?
No.
Am I going too slow?
No.
Okay. So equity is where when you actually make an investment in a company or a project and you become an owner. So it's different than the co-op loan. A co-op loan was an equity. Co-op loan was a loan. But equity is where you say, I'm going to invest in Daniel's newest and greatest business. And he's looking to raise $20,000 from local investors, and he's going to give me some stock in this company. And so you make an investment into Daniel's company. It's no different. When you're making an equity investment, it's the same exact thing as making an investment in buying Procter & Gamble and Colgate and all those others. That is an equity investment. Because you're buying stock, even though it seems really not close to your heart or seems abstract. It's like, I just, over the internet, bought a stock. And I bought whatever, so many shares of the stock. You're becoming an owner in that company through its shares. And that's what one of the choices you can do. And one of the key decisions, and then you have to decide as well, if I want to be an owner in stock or an owner in companies, do I want to do it in individual companies or do I want to do it in a fund, which is this part here. And unfortunately, all these here are limited really to accredited investors.
Wait, are you saying that only an accredited investor could invest in Daniel's little...
Legally. Because you see, the moment Daniel, I know she's an attorney, and she's my partner, but but she's not an SEC attorney. The reason is because Daniel is making a securities offering. Like if he offers stock or debt, the SEC sees that as an offering. And the moment he makes the offering, you're not like, you could invest in it if you want. I mean, the reality is, the Daniels of the world and me, when I started out, what did I get? I got money from friends and family. Was I in violation of the SEC rules and regulations? Yeah. Did anybody know about it? No. Probably 90% of the business in the United States are started with friends and family around. But once you get to a critical level, like when you start raising serious money, when you're raising $1 million and you get a radar screen, you're required to go to blue sky laws. You are required by Vermont law to post it up in the Vermont Banking and Insurance
I'm a
Department.
little confused, because we can all invest in Procter & Gamble without
Right.
being these
Correct.
special people. What's the
But Procter & Gamble is a public company, and the SEC laws are saying that we, as investors, if we're not accredited, are not allowed to invest in a private company because it's a domain is considered a security. And this is not about right or wrong, it's just what the law is,
So Daniel's pretty much done with commercial companies for profit, but what about, two things, what about creating a nonprofit entity that people could invest in where we reinvest that money in community projects? Or two, what about creating a local stock market, essentially, that has very predefined methods of investment and funding?
Well, I think you're onto something. Somebody said to me, I think it was Ward, you guys were talking about the BidCos, right?
Right.
So, I mean, a BidCo is a business investment development company. And they are a legal form of where You don't have to be an accredited investor, but you can invest into it. It's almost like a mutual fund. And that entity is allowed to invest in other businesses.
Like a business incubator.
How's that?
Kind of like a business incubator.
Yes,
So
right,
we-
very much so.
we
That's a
could-
good language. That's very much like it. And for some obscure reason, the SEC says it's okay to invest in a note issued by a nonprofit or religious organizations. They can do it all the time. I mean, I can give you 500 organizations that are religious or nonprofit that issue notes all the time that non-accredited investors invest in. And the SEC is fine with that. They're just perky about like when you do it to businesses. So that is a good solution, and I think it's worth exploring because it's people have tried to do it. It hasn't happened yet on a big level, but it's probably happening regionally. And I've never read Michael's book yet, but I know it's part of his book. And I think we as a community should look at the bidcos. Because otherwise, quite frankly, we're excluded from doing other things, some things that you'd want to do.
Is that at all related to the 3LC?
L3C.
L3C is a type of business designation that the state of Vermont and several other states have approved, and it's a quasi-commercial, quasi-nonprofit limited liability company. So it has
It's a low profit for education and/or charitable.
it has
Work.
what
That's
could be
it.
the best of many worlds.
But I mean, is that a solution for somebody who wants to invest?
I don't know that we go that route as such.
No.
Because I don't know that.
No, the organizational structure doesn't matter. It's more about like what's the nature of the offering, which is it seen as a security? And the moment any lawyer, like Ken Merritt, my attorney, says that's a security, then it's hands off unless you're a accredited investor. The reality is most Americans have not paid attention to the law, and the investor is not going to get in trouble if they don't. It's only the company. And the reality is the only time the company gets in trouble is if a group of investors are the not accredited investors, because with coming with this jargon, accredited investors, not just that they have money. In theory, you have professional expertise and access to professional expertise to truly discern what the risk is.
Yeah,
That's the point. That's the theory, you know. And they say, well, so therefore you're not going to be duped into making a bad investment. That's totally ludicrous. It's totally ludicrous. But until Sanders and other people change the law, it is what the law is. Other way we can invest is debt, and we would have to then decide if we were group investing or if you're an individual. You still have to make the same decisions about if I were lending money to local businesses, which I've done maybe a dozen times personally, and professionally I've done it a lot, but personally I've done it as well. You have to decide, am I going to do easier credit standards or the same credit standards as a bank? And obviously most of us are going to say easier because if they could get it from the bank, they would have already gone to the bank. The reason they're coming to you is because they can't get it from the bank. So probably by default you're going to have to, if you're going to be in a situation of lending debt, doing it on standards that are less rigorous than a bank would do. The question then is when you make your loan terms, are you more flexible? Are you willing to give longer loan terms? Or banks, for example, for almost all private businesses that start up will require personal guarantees, which means, hey Bob, you borrowed $100,000 and if this doesn't work and your business tubes, you personally will guarantee this. I'm sure Howie's guaranteed some debt in his life, I bet. You have. And you're liable. I don't care if all your companies go bankrupt. You personally are liable, and we're going to take your house if we have to. Now, there are laws about what they can and can't take. But the reality is, so we'd be in a situation, do you want to say to somebody, I'm just lending your business, and I don't need a personal guarantee. These are all details, but they're actually important details because they affect, what happens if something goes bad, Because if something goes bad, then you want to know what your recourse is. And then you obviously want to know if you're lending debt, do you want to do a higher or lower interest rate, or same interest rate as market. Some people could argue, well, I'm taking more risk, and therefore I shouldn't get a lower interest rate, I should get a higher interest rate. Other people will argue, which I've heard, and I've had clients argue to me, interest is usury, no matter how you look at it, it's all bad. And That's a pretty, okay, I'm not against that. Why do we even come up with the concept of interest? I mean, who invented this? I mean, it's like private property. It's just as bad, you know? Who invented private property? It's very self-serving. But we have private property and we have interest. So we have a choice as individuals to say, how do we deal with what interest we charge? And that can be on any level. There's no right or wrong. I mean, I think people just have to decide.
I want to just counter one of your early assumptions, and that is to assume that if somebody's coming to their community for the debt, that they can't get it from a bank. And a lot of the thinking is, don't give the bank your interest, give your community your interest. That we have to make a shift to seeing it that way. That if I'm going to be paying someone, I'll pay my neighbor for them enabling me to do this.
So is that something we aspire to, or are you saying that's something
Yeah,
that
I'm saying
happens?
that is part of,
Yeah.
we're going to go to that dinner on Sunday. That's part of that whole thinking
Right.
of creating wealth is to emulate better banking practices at a local level. So I've talked about state-owned banks and the transformative
Well, that would be
power
great. I
of
mean, if we
that.
create communities in which we want the business to say, I'm not going to the bank. I have a community revolving loan fund here. I have friends and neighbors organized in some way so that I can actually efficiently and effectively get something in a timely way.
And so
That would be great.
to me, that's sort of a transition counterculture to build those kinds of
Right.
systems and assumptions.
That'd be good because banks aren't lending. Yes?
There's also another way, a mechanism to raise capital, which is like crowdsource funding. It's sort of an open source method of soliciting from the community for a given project, and then sort of creating a mechanism for a company that would actually be receiving funds and then reinvesting them into the project. So it's probably, it goes under various names, but crowdsource funding is.
I don't know what that is, yeah. Is it in Michael's book there or whatever?
No, but if you Google it, you'll.
Okay, crowdsource funding?
Yeah, there's a number of
Okay.
There's a number of internet companies that are facilitating this online,
Right.
where you can donate to various.
Well, I mean, Ben & Jerry's, when they went public, that was a way to allow everybody in Vermont to participate. It was brilliant because they did what they call a direct public offering. Instead of doing an IPO on Wall Street, they just flogged it, in town halls and said, you can invest. Every mom and pop was allowed to invest in that. That's not against, because it's publicly traded stock, it's not against SEC law. But if Ben & Jerry's tried to do that in the town halls as a private company, they would have been in jail. I mean, because they couldn't do that. So the ways to invest, though, are equity and debt, and there are different forms of debt. And I realized I gave you two, like senior debt and junior debt, but quite frankly, there are many variations of debt. If a community wanted to invest in debt, what we'd want to look at is like, well, if we're providing debt, where is there the gap? What is it that is most needed? Is it around construction financing for affordable housing? Is it bridge financing? Is it pre-development money? Like, where do people need debt that they can't get? Because if they can get it easily from the local bank or the credit union, we could either just be in parallel with them, which is what you're saying, which is like, well, the entrepreneurs should have a choice to basically keep the money local with their neighbors, or choose to go to, unfortunately, if it's a bank, it's probably it's a big entity, and it's not likely to be just Vermont. So this is the SE thing. There's the language, my friends, about accredited investors. So the Securities Act of 1933 basically just brings out, saying what the requirements are. When the number one is the $1 million, and the number two is the $200,000. And that's why I say it's complicated. There's a lot of people that have been thinking about it, and I think there's a lot of effort. Like we'll have to find out the one you said, Daniel. If you can send me an email on that, I'll take a look at it. Because the more ways we can creatively look at getting around the system.
Well, there's another
legally.
There's another company in California called Solar Mosaic, and they've only rolled out in California, but basically you can buy individual PV panels on a large PV project as an investment.
Yep.
So it's yet another way to.
Because you technically get a proportional share of the power, right?
Well,
And they're reselling it though, and you're going to get cash.
Right, you get a proportional share of the,
Right.
of the proceeds.
So that is a way to get around the SEC laws.
And solar gardens are similar to
Right.
that.
In fact, I think I have it here some places to talk about that one way. I have a few slides on non-accredited investor stuff. One of the ways to invest is to think about being in a community solar project.
I have a question. The previous slide, we kept saying natural person. Now, is that, I mean, corporations have now, they're legally persons.
Well, they have, this is only about the people part. The law actually has a whole thing about corporations and
Yeah.
trusts, and so this is just talking about individuals, not
So
corporations.
can be.
Corporations can clearly be accredited. They are, if you're an investment advisory firm and have over $10 million, you can make there's a whole bunch of laws for them too. It's not, I mean, leave it to the government. That's why somebody said we have 70,000 pages of IRS rules and regulations, and I think that's why it's complicated. That's why, and it shouldn't be so. So if you are an accredited investor, the thing that I would just suggest is the easiest way to make investments would be to go through angel groups. And so for anyone, an angel group is basically a group of individuals who are banding together, much like we're talking about tonight, to make investments in private companies. And most of them don't do it. I mean, it can be done collectively, and the due diligence can be done collectively. And then, so that saves you from being basically doing it entirely on your own. And it would be safer. In Brattleboro, just so that you guys know, that the slow living, the slow money guys are creating a group to do this right in Brattleboro right now. And Vermont already has in Burlington the Vermont Angel Network that Ken Merritt, my attorney, runs. And then there's a whole bunch of other groups. I gave some examples, but if anybody is in that situation and interested, I could give you examples of where the angel groups are. Or if you just do Google, you can find out where the angel groups are. It's a good way, because quite frankly, it's a way to self-educate, do things collaboratively, and not have to be doing it totally alone. You could also invest in a fund. So right now, there's a fund in our state that's being offered by the Sustainable Jobs Fund, and it's called the Sustainable Jobs Flex Fund. But the minimum investment's $100,000, and you do need to be an accredited investor to get into it. But that would allow you to participate in a fund that's investing in exclusively Vermont businesses. And I'm actually an advisor on the board to that fund. In the past, we had two others, Fresh Tracks and Green Mountain Capital were two funds that you could have invested in, but they're closed, so they're history.
I know that Vermont Land Trust also has a revolving debt fund that they look to raise money for. I'm not sure whether you can be accredited investor or not. But
The land trust? Probably not. See, that nonprofits are exempt from a lot of this crap about accredited investors.
Right.
So you could give to the Vermont Community Land Trust, I'm sure anyone can give $500 or $50.
right, and for that specific fund, I know they're using it as a bridge loans to buy properties that they haven't done, appropriate fundraising.
Right.
So if they find a farm that they want to protect and purchase, then they'll use those funds. And so they're always trying to replenish it, because the larger the fund is, the more they can float, the more they can carry.
So it's a really good purpose, too.
Exactly.
Yeah, absolutely. Thanks. Yeah, if other people have ideas of where you can invest, bring it up now, because there's not a lot. Daniel, yeah?
I don't exactly, but I do know that at least one entity could not go forward with a solar PV installation here in town because they couldn't get the bridge fund, the bridge loan funding that they needed, and they really only needed it for a short period of time, but the banks were not flexible enough, and so the whole deal was...
Yeah, the bank more or less said, I'm not doing construction financing. I'll do the permanent financing maybe after it's done, but you have to worry about...
that kind of thing could be actually attractive, because you could say, well, if the bank won't touch it, we'll do it for 6%.
Right.
And as an entity, if we did raise money locally
Right.
and had a big or whatever mechanism we use,
Right.
it might be actually lucrative to help finance renewable energy projects.
Right. We did, as Catalyst, not me personally, One of the things, I manage a $12 million fund for the state of Delaware. And we did a $3 million loan for a construction loan because the local people doing affordable housing, and I mean deep affordable housing, very low income, were having to go out of state to Utah to borrow money at 7 and 8% because the local banks in Delaware were not willing to really meet the need for affordable housing for construction loans because some of the stuff didn't get built. So there's a risk. When you make a construction loan, if it never gets fully permitted, you're sort of stuck. And you go like, wow, I wasn't a permanent lender. I thought this was 18 months, and now you have a loan for a long time. Solar is quite different than that. But, you know, it wound up becoming a great service to the housing authority. And, you know, it was like us trying to figure out, like, where is there a need? Because the pot of money that the state had, they wanted to fill a need that the banks wouldn't do. So that's what you're saying, is basically, heck, somebody else, if a group was around, that project could have happened. Yeah.
But let's say that I'm interested in supporting local food production, which I am, and Howie's a farmer over here, and maybe you can come up with a fictitious or real project that we might fund as a community, and take a look at what that might look like.
Correct.
Does that make sense? So you come up with a project,
sure,
and you come up with a tool in which the community can fund a mechanism. We
would try to do that, sure. I mean, CSAs are one thing you've already accomplished it in a certain way. I mean, but I'm sure you have other projects, but the whole idea about a CSA, where somebody's paying in advance before you produce, is a great way to get funding to you and take the risk out of it for you. And I think it was brilliant. You know, whoever started it, and you probably have been one of the first.
I think it started in the Netherlands, the early ones.
I mean, it's totally, to me, it's great. It's like, what if you want to invest in a community, why isn't everybody in a CSA? I mean, because why should farmers take the risk of the weather? We should be taking the risk as the consumer. You know, it seems to me that the risk should be on our side.
It's kind of like Hardwick, where people bought shares or bought 100 meals in the restaurant before they opened the restaurant. They had the capital.
Well, that's why the community solar works, because you can buy a fractional share of something, and then you could take title to the power. I don't know how Tom's doing it, or you have them resell it back into the grid. But it's not the same thing as making a private investment.
And what if Howie, for example, was building a $50,000 greenhouse? How could the community help him? What kind of mechanism might work for that?
The easiest way to help local people, in my opinion, is to create a revolving loan fund, because you get around all the SEC things, and you don't have to create fancy, wacky mechanisms. I mean, if all of us if we had $250,000 in a revolving loan fund, and we all decided what I want to do, we can make a loan to him tomorrow and not in big trouble. That's a pretty easy way. Doesn't take a lot of time. You don't have to spend $200,000 in legal fees to get it done.
How much do you have to spend on legal fees to get it done? I think. What would it cost?
To set up a fund?
Yeah.
Well, that's always a question. Like, would we set up a fund, or would we go to, say, the Vermont Community Loan Fund? And that's not a recommendation. We're just like parallel, and go to them and say, our community has $250,000. And we wanted to do these things, and we've decided we don't want to replicate what you did because we noticed how much money and time it took to do. Would you run this for us? And what would it cost? And then you could have somebody else administer it. That could be started really fast, because that's just a negotiation between us and the revolving loan fund. You know, it could even be a credit union might do that for you. You know, that would be much easier than starting from scratch, because you have to incorporate. But you know, it's like getting a 501c3 and all this stuff. It's time consuming. You're down. I mean, we could start this next week if you could get the deal with whoever the revolving loan fund is to the bank, whereas we would be a year away if we had to organizationally start it.
And the parent organization, Vermont Community Fund or River Valley Credit Union, would then take like a monthly fee or some percentage of the fund, or
I mean, you would outline to them in a scope of work, like, these are the things you need to do for us. You're going to probably, they would do the due diligence, which means the credit underwriting. But we could set the standards and say, right, this is the standards we want. You know, they're different than yours. This is yours, and ours are easier, or whatever. Or we could tell them what to do and ask them to administer it for a fee. They could do the billing and collecting, which probably nobody here wants to do. You know.
So we might want to talk with Jeff Morse, the CEO at the River Valley Credit Union, and ask him if he would.
Now, another way to do that, and I think I actually say it a little later, but so I'll say it twice because. Since we're talking about it now, is another way is for, if we had a pot of money, is to co-invest it. So, and I think I said in the last slide, you know, I'll wait. I'll give you that because I've got some little outrageous ideas in the back end that will take some work to do. But I'm doing it with institutional money, but it hasn't been ever done, you know, with individuals. So if you're not a credit investor, what can you do? And credit investors obviously can do this as well. It's not like they are excluded from this, but you can go to all the revolving loan funds or any place that you found that is issuing notes. And there's a lot of places. I mean, you could literally pick and say, oh, I want to go to Axiom International because all they do is they make microloans to women in Asia and India to help start businesses. And it's a great thing. So if you're into, you know, helping women start businesses and empowering women and educating them in Asia and India, well, then Axiom International is a great place to go. And there are literally thousands of funds like this. I mean, it's mind-boggling how many there are. So if you guys start Googling micro loan funds and revolving loan funds, you'll be doing it to Christmas, looking at possibilities. So some of them that I mentioned that are local are, I haven't personally done the Institute of Community Economics, and I've done the New England Cooperative Loan Fund. I've done all three. The New England Cooperative Loan Fund is, as it sounds, it invests in New England businesses, mostly cooperatives. The Brattleboro Food Co-op has used that fund in these last two expansions, I mean, to make a critical difference where Vermont National Bank, who was the senior lender, couldn't make the difference. And even with this last expansion, with Brattleboro Savings and People's Bank coming together, they were still short, and they used some money from the New England Cooperative Loan Fund. So all those three that I'm mentioning do good things. Institute of Community Economics is a little broader than Vermont would be, but I'm only giving them by examples and not recommendations. Obviously, anybody could invest in notes through Calvert or this, like the Wren notes I talked about, or we can do specific projects, and I've talked about them before, so you've already heard that you could have done Brattleboro, you could do solar. Clearly, I think something that a lot of people are interested in is how do I get involved with investing for community solar? And I think, I don't have the legal answer to that, but I think it's one of which I'm interested in chewing on and exploring with people, because I think, you know, investing in our renewable energy and the local economy is really important. So there should be a chance for us to do some of that. So here's the wild and crazy things, and then we can open up the discussion. We could do, now this is, I've never seen, and I can't say never, I mean, individuals do this occasionally, but you think of it more like in a mortgage, like you have a son, and they can't get a loan, or you can't get a car loan, you guarantee the loan. There's no reason we can't guarantee loans, either as a group or as individually for businesses. So it doesn't mean you even put up any money. You guarantee some portion of the loan or the whole loan. Not a recommendation again, but it's certainly, I mean, that's what the government does when you think about the SBA, the Small Business Administration, or HUD or VA. These are all government programs giving some guarantee to get local banks to do something. So a guarantee would be a way to get local banks, or even a revolving loan fund to do something. Yeah.
The Pinnacle Association regularly uses guarantors when they're purchasing land to, sign notes for $5,000 or something like that in advance. So that allows them to get the funds. And
so that's a good example. That's right here.
That's right. And
right.
There's no benefit to being a guarantor.
Right.
There's no benefit.
It's not an investment.
In farmers' interest is concerned, but there's a huge investment because there's 1,600 acres that are conserved, adjacent to us. So that's where the benefit is, and so that's used regularly for conservation purposes.
Well, that's great. See, I didn't know it was being used here, so that is pretty exciting to know. I mean, in my mind, I'm thinking, well, what we could do? Well, we could start guaranteeing things that are cool projects. Now it's not an investment. True, you could make it into a small return, like charge a fee. But it might throw the project off. I mean, I think most people doing the guarantees. I mean, there are people and there are businesses that guarantee loans professionally and get paid to do that.
Right. There's another example that they were putting a roof on the community center over in East Putney, and to get some loans or some fund at the state level, they needed a certain amount of money up front. And
Sure.
They requested to have several people contribute $1,000 each.
Sure.
To get started on that.
Right.
And, I and several other people contributed $1,000.
Yeah.
I got the money back with no interest
Sure.
a year later.
Right.
And I also was able to get a little money.
Right.
But it allowed the project to get going until they were able to raise enough money
Great.
locally, they took some loans out.
Well, this is great, because now you're making my juices think here. There's actually a really successful example where individuals have done this. And I don't know if anybody here follows Rudolf Steiner or Waldorf schools.
Yeah.
Okay, so the Steiner Foundation, through the Waldorf schools, when they started their revolving loan fund, a friend of mine, Mark Finzer, started it many, many years ago. And their theory was this, like, we're going to do almost like circle lending that's done in overseas. We're going to make loans to Waldorf schools only, which is where they started. And now they're way outside of Waldorf schools. And we're going to make sure that every parent becomes a guarantor on the loan. And they said because they're going to be really vested in making sure that the school is successful. And so they did this circle lending, and every Waldorf loan had parents as guarantors. And they had very, 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 very little defaults. And now Mark's built that up. He's still the chairman, but he's not active like the CEO anymore. To $120 million worth of loans they're making through a revolving loan fund, of which every one of you are allowed to invest in if you wanted to. Like just Googling, the RS Foundation, and you could sign their note and give them money. And I gave them money 1987.
I think Claude Pepin is on the board of RSF. I think Claude Pepin. I don't know if you know Claude or not. He's from West. He's very connected with that.
But the fact that we can do Pinnacle, that's local. That's great. Or if you do what you're saying, you got a town hall, that's local. So guaranteeing loans, yeah, Daniel?
Well, so right now, say there's a project, there's actually several phases of a project going on at the Putney Central School, where they're doing weatherization, they're doing their boiler, and improving the efficiency. They basically, because they're a school and don't have any tax advantage, tax appetite, they have to come to the town and ask for a bond, and that then, is a mechanism. But that, I'm not sure how we could look at that at a local level, at a local investing level, and do it one better.
So is it energy efficiency and renewables, or energy efficiency?
Well, right now it's energy efficiencies, but the next phase could well be renewables.
So the simplest way to do that, which is part of what I've done over the last 30 years, is to organize what we call a tax-exempt lease. And then either an individual investor could do that, a local bank could do it. You don't need to bond for it. It's perfectly legal by Vermont law. And you can have it done next week. And if you said to me you needed $1 million next week for Putney School, I could get it. Guaranteed. I wouldn't need to look at anybody in this group. Because there's just a lot of people that do that. That is it's a domain in which there's a lot of investors. Because the money that when you're an investor in that, and when I say tax exempt, the person who lends that money does not have to pay federal government taxes or state taxes on it.
And they also get to make use of federal incentives and rebates for the purchase of solar equipment, right? So
they wouldn't be the owner, they wouldn't have the advantage of any of that. There were other structures to give it so that the investor gets the ITC, and the depreciation. But just a regular tax exempt lease. Right now, like somebody told me yesterday at the REV conference, that Goddard College used the tax exempt lease to fund some energy improvements, and they got it for 2%, 10 years from a local bank. Pretty cheap money, and like that you can get. So forget about a bond. That's going to take forever.
Well, that's the mechanism.
But if we had money in a pot, local investors could do the same thing. So instead of it being an outside group of investors doing it, which is mostly institutional investors.
Could you explain that one more time? Tax exempt lease.
So it's the lease. Well, the lease has a lot of baggage with it. So it sounds like you're leasing it. You don't have to write down. It's a finance mechanism as an alternative to a bond. A bond is technically debt. So you have to have a notice, and you have to get people to approve the debt. A lease.
So it's a bond.
It's an option to purchase it at the end for $1. So it's essentially a financing, but it's not legally considered debt, because when you do a tax exempt lease, I didn't say this because it seemed like it's too complicated, but the technical side is, if we here in the library use the lease to fund all the shelving and the computers here, we would have the right, as the town of Putney, every year to vote whether we're going to continue to pay for that. It's called yearly appropriations. Whereas if we did it through a bond, we would be locked into it forever. You can't get out of it. It is hell or high water is the language in finance. Whereas a lease, you have the right to get out of it. And if you got out of it, then you would no longer owe the money. So there's, and you don't have to bond for it. And it's tax exempt because the people that invest in it are not having to pay any income taxes on it. That's where the tax.
So your return on investment comes from the tax savings, not from a direct, any kind of direct.
Well, I mean, if you're getting a 3 or 4% return on something, and your tax bracket is 30, 40%, you divide your tax bracket into your return, and that's what your pre-tax return is. So it's going to equal. It's going to be a higher number. It's going to be like 4%.
Right. Okay.
The reason why investors do that, I mean, and why we've done a lot of it, is because there's very little. It's a safe investment because it's always in the public sector. I did have a few times where investors got burned, like in Keene, a school system that we lent money to, closed the school down and then sold it to a third party. They sold it and they commercialized the school. They de-schooled it. I mean, it's like, because the demographics weren't good.
Wow.
So they made it an unschool and they sold it off and made it into condos. Well, they called it, what happened is they non-appropriated. They said, well, we're not going to pay these leases the next year because we don't have a school anymore. And that was perfectly legal.
Right. What happens though, is that one of the risks of that kind of mechanism?
That's one of the risks of that investment. But statistically, I mean, it's a big business. It's about $50 billion a year. And it's almost like an algorithm. The chances of I've only had one in 30 years non-appropriate, and that was Keene, out of having done 300 or 400 million of them. And it wasn't huge. It was like $20,000 or $30,000.
Only public sector can use them.
Only public sector. City, state, county, state government, public schools. And actually, nonprofits, universities and colleges can use it. Not, again, this is our government being complicated. They can't directly issue it, so they have to go to a conduit agency, like a VITA. And then VITA can issue the debt on their behalf and make it tax exempt. They themselves don't have it. Because you have to have the power of eminent domain and taxing authority to be able to do tax exempt anything. And like, so our city can issue debt, it has power of eminent domain.
VITA is Vermont, what is VITA?
Huh?
What does VITA stand for?
Oh, the Vermont Economic Development Authority. So if you were a college, like the Putney School here, they're not allowed to issue tax exempt financing on their own. But the Putney School could go to VITA, or they could go to any number of other agencies that have that authority and get tax exempt financing, which I'm sure they do on any big project. Another thing we could do, I've got 4 possibilities here, is you could fund companies with something called royalty notes. So if we were a group of investors and we had our $250,000 here, or whatever we had, we could decide, well, this thing about investing in shares is too risky. I don't think I want to own stock in this company. Because when you own, you're the last to be paid. And I also, the company may not really want a lot of debt because it's already maxed its debt out with its local banks. There's a lot of conditions where companies will just not borrow more money. So they're in this crazy thing. I need money, but I can't borrow more because unless I get my bank to give me exclusions, and I don't want to do equity because it's too expensive. So there's something in between those two things, and it's called royalty notes. It's not been used very much, but it's where you take a percentage of the revenue of the company. So if we had a local bookstore here and we said we wanted to do royalty notes with them, we'd say, all right, you don't owe us a principal and interest. We're going to give you $50,000, but you don't have to pay us back principal and interest on a note, but you do have to give us 5% of your gross sales every month. And I'm making a number up. That's not the right. It may not be the right number. You'd have to figure out what the right number is relative to what you really would want. The advantage to them to do that is, one is they don't have a loan, so they're not have a balance sheet issue, in terms of tax, their accounting. They're not going to be violating covenants with banks that might say you're not allowed to borrow any more money without our permission. So it's a way to get around it. The New Hampshire Community Loan Fund, that's what the NH is, the New Hampshire Community Loan Fund, is now got several $1 million out like this, taking investors' notes, local investors like us, and administering that kind of program. And it's actually been quite popular with businesses in New Hampshire. It was done actually 20 or 30 years ago. It was very popular and it lost popularity. It was like a lot of things, there's a pendulum, You wait long enough, it comes back. And that's why I wear the same shirt. You know, I wore this when I was in college, and it's still popular. You know, it may go out, but I don't care. It's going to come back in anyway. So that's one we can think of. Here's another way you can actually help your community. It's called linked investments. Now, this is done by foundations and really big institutions, and it's where somebody deposits money into a bank or a credit union. It doesn't have to be a bank. Someplace where you're going to earn interest, and you give up the interest. And you say, "Don't give me any interest," and use that interest to pay off this other loan for some other worthy cause. So, when we were in a world where you were getting 5 or 6% on your money when you had it deposited, that was a really great social change mechanism. Because, I mean, we used it like in the Mohawk Nation, where they couldn't, the Indian tribes have all this tribal land. It's really hard to lend to Indian nations for a lot of reasons. So we got a foundation out of Washington, D.C., willing to do a linked deposit for a few $1 million to help an affordable housing project on a reservation. They couldn't get funded because the local bank was charging them too much interest and they couldn't make the numbers work. And so at that time, this was actually in the late 80s, so interest was really high. And they were forgiving about 8 or 9% interest they were earning on their accounts and saying, give all that interest. So that was a way for them to put money up, take no risk, and help a project, but by giving their interest away. So that's something people could do. It's not really an investment per se, because you're not making money on it, but it's a way in which your money could be used to help causes, no differently than a guarantee. You're not making money on a guarantee, but you're helping a worthy cause.
Just need a return.
Huh?
Just need a return interest rate, which we don't currently
Yeah.
have.
And there's a lot less risk with this than a guarantee.
With a linked deposit.
Yeah.
No, there's no risk.
There's no risk. Well, that's
You're just saying, I'm putting my money up, I'm going to get my CD, I don't take the interest, I donate it, and it benefits my particular cause.
That's what you do anyway with checking accounts, you just leave it in the bank.
Right now, we're donating our money to the banks and the credit unions. I mean, it's not designated, it's just, they get it, you know. Oh yeah, give us 0.2%. So last thing, which is I'm doing a lot of right now, but it's certainly not been done with individuals, but where you, and I think it could be, quite frankly, done with individuals if we cut a deal with a local bank or a credit union, where we had a pot of money, and we go to the bank and say, okay, you're going to have losses. Like, I'll give you a specific example. A lot of the money that I'm helping with the stimulus fund money, I've been able to get banks over the last 2 years to lend $10 or as much as $20 against $1 a loan loss reserve.